Welcome, everyone. I'm Chris O'Day. I'm the Director of Marketing here at LGA, and we're here to welcome you today to the One Big Beautiful Bill webinar. Today, we're going to be discussing the One Big Beautiful Bill, its tax provisions, and some planning opportunities for individuals and businesses. With me today, I have Matt Foley, who is a partner here at LGA in our tax practice and also the co-director of tax. Matt has looked over the bill, has some insights for individuals and business owners, and we look forward to giving those today. So without further ado, I'm going to kick it over to you, Matt.
Hey, Chris. Thanks for the intro. Appreciate it as always, and welcome everyone. Appreciate your time, and happy to go through the One Big Beautiful Bill, OBBBA, BBB. I always wonder how many B's I can get in, OB3, and we'll go through some highlights here. I'm a tax partner. I love tax. The running joke, Chris always calls me on it. I'd show the tattoo. It's not appropriate, for this type of webinar. But happy to kind of provide some guidance and insights on what we've seen as we've digested this. So here's a brief agenda of what we'll go through. We will give an overview of the provisions, the impact on business owners. We'll emphasize for you on the individual side, the importance of lowering your taxable income and AGI. A lot of the provisions that came in through OB3 do have phase outs, and the importance of phase outs. And as we do modeling for our clients and kind of education for our clients so that they understand where maybe the benefits fall off. Roth conversions, it's something we've seen clients as they've entered that retirement phase of their life take advantage of, and given the consistency in tax rates, the other economic factors out there, we do think that'll be a very common planning opportunity that continues to get taken advantage of. So we'll highlight that, kind of let you know what we see there. And then wealth transfer, the estate tax. So we'll go through that. So overview of the OB3. This was first introduced in the House as HR 1 on May 20th, 2025. Signed into law on July 4th, 2025. So it is interesting. The original Trump tax reform was signed right around Christmas. So there's something about holidays and tax legislation in this presidency. The legislation continues the trend of major legislation enacted through the reconciliation process. It stands out among recent tax legislation based on the general lack of hearings or other legislative history accompanying the legislation. It makes many provisions of the 2017 Tax Cuts and Jobs Act permanent. Many of the individual provisions that were introduced as part of that bill had a 10-year window, and so they were scheduled to lapse and sunset, and that would have caused, as you can see here, a $4.5 trillion revenue increase over the next 10 years. So now it's shown as a net revenue reduction, and that now that won't be paid back. It does provide additional tax relief, including enhanced child tax credits, standard deductions, small business deductions, new tax break for workers, some of the campaign promises. So no tax on tips, no tax on overtime, deduction for auto loan interest. The effective date again is July 4th, but the effective date of many provisions vary. So it's definitely something that we have to stare at, when do these things fold in? There was some changes to business provisions. These were bipartisan updates. While the bill's not bipartisan, again, done through the budget reconciliation, there was kind of sound support on both sides when we look at R&D expensing, full expensing of capital expenditures, a couple other items that we'll go through. Other quick highlights just to hit on. There's the $15 million estate and gift exemption. You went up from 10 to 15. It didn't relapse back. Still have the basis step up at date of death through the inheritance, which is great. Income tax rates will remain the same. QBI deduction. This is a deduction available to small business owners. There was kind of a conversation about whether it would be maintained and the like. It's still there, which is great. State and local tax deduction, definitely one of the more interesting provisions with the Republicans in the blue states pushing for this. And we'll talk about how it's now up to $40,000 with the phase out. And so there is some relief for people living in those states. Qualified small business stock exclusion. This is for investors in C Corps, entrepreneurs, VC area, venture capital. There was an expansion of these rules, and there's some real excitement as we talk about others in the transaction advisory space and entrepreneurs to take advantage of those. And so there's a lot here. And so let's jump in to just an overview of the brackets. So for your benefit, you can see here on a pyramid structure on how the tax rates phase in, single, married, filing, joint, along with the capital gains rates on the left side. The enactment of this bill, there would have been an increase in tax rates essentially for everybody that would have kicked in, as we would have went back to the pre-2018 tax rates. Also would have been what we refer to as the marriage penalty kicking in, where married filing joint ended up paying more than they would have as single filers. So that's been cured, and you can see the capital gains rates as well. I know it's been a couple months since everything kind of kicked around, and even longer than that, but just a reminder of some of the things that you may have heard. Hey, did that make it in? Did it not? Who knows? I don't remember talking about these at all. Well, sorry, but I'll refresh you. Anyway, some of the stuff that was out there was a corporate tax rate change. The Tax Cuts and Jobs Act took the maximum C Corp tax rate from 35% down to 21%, viewed as more competitive in kind of the global landscape. And there's some who say it should be lower, and there's others, I think more on the Democratic side, that said it should be closer to a 28% rate. It's been maintained at 21. That's still permanent. There was a proposed incentive for domestic manufacturers that would have brought the C Corp rate down to 15%. That didn't get legs. There was a domestic manufacturer incentives prior to the Tax Cuts and Jobs Act called the DPAD, Domestic Production Activities Deduction. So it would have been a little bit of a blast from the past, but it didn't get enacted. The perceived carried interest loophole, the incentive for the PE and VCs where they can set up a carried interest, meet a hold requirement, and get capital gains on their returns, that's maintained. Capital gains tax rate is stagnant. It didn't go up, as I just showed you. Tax rate on high-income individuals. There was a proposal for state and local tax limitations on corporations and also owners of flow-through businesses. Neither of those went through. Unfair foreign taxes. It's an interesting landscape in the global space in the taxation of multinationals. This was a proposal that was pretty far-reaching and a little scary, and it didn't move ahead. So just to highlight some of the stuff we were staring at, no changes happened here, and just something of note. So now as we pivot, we'll focus on business owners first here. And one of the provisions that when we were in the last year in the fall and kind of staring at the election and what was going to happen in tax reform subsequent to that was the 199 Cap A deduction. And this is a very powerful provision that got introduced as part of the Tax Cuts and Jobs Act, which allows for business owners of certain qualifying small businesses, flow-through businesses, so these are your S-corps, your partnerships, and your sole proprietorships, where they only pay tax on 80% of their flow-through income, subject to certain limitations. It's interesting hearing about the economic impact of this provision. The economists that I've heard talk about it, definitely not one that they love. They don't say that it drives economic activity. It may have been on the cutting room floor, so there was some fear there. And this is a large subset of our client base, owner-operated businesses. There was also a belief that maybe it would be expanded. Currently, service businesses, accountants, lawyers, healthcare are precluded from claiming this deduction when they're over certain income thresholds. That didn't get enacted either. So it's somewhat status quo, which is welcome, and something that we're happy to see for our owner-operated businesses. It would not have been a fun conversation to go through and say, hey, your taxes went up 20% as a result of this. There was some changes. It is permanent now, which is good. There was an increase on some of these phase outs. Again, I mentioned when you get over certain thresholds, there's limitations that come into play. Those phase ins or phase outs did get increased, which is good. And one thing that we see, we'll talk about a little bit, is with the increase in the estate tax and the ability to gift through life and death up to $15 million, $30 million total for a couple, there's definitely an opportunity here to look at some trust planning to replicate the benefits of owners of flow-through businesses, really optimize the 199 Cap A. So we haven't had a ton of clients pursue it, but definitely something we've talked about, and we could see more of given the permanent nature of this going forward. Another, I mentioned before on The Economist, how economists weren't all that supportive of maintaining or expanding the 199 Cap A. One provision they do love, and they are very much behind, is bonus depreciation, 100% expensing for qualified capital expenditures. And this is now permanent, effective date of January 19th, 25. And so there's 100% write-off for kind of all fixed assets, assets with a useful life. I believe it's under 20 years and under. And it's a really, really powerful provision. There was also for small businesses an expansion of Section 179 deduction, very similar provision of bonus, but more states conform to this, so it can be even more impactful. The limit you can see went from 1.25 million a year to now 2.5 million. So small businesses in our client base will really, really be able to benefit from the immediate write-off of capital expenditures in a year, which is just great, which is really a nice provision. Another provision that got introduced as part of the Trump tax reform back in 2017 was a limitation on the deductibility of interest expense. The goal was to pull back on the reliance on debt and maybe debt-funded buyouts, PE acquisitions, what have you. And it limited the ability of a taxpayer, it could have been a C Corp, a flow-through owner, to deduct interest expense based on an EBITDA-like number. It's referred to as adjusted taxable income, but think of it as EBITDA. Beginning in 2022 or 2023, it went to EBIT. So there was no longer an add back for depreciation and amortization. This caused those capital-intensive businesses or acquisitive businesses to have a limitation, sometimes severe limitation on the deductibility of interest expense. And so there's a welcome change back to the EBITDA-like standard for computing adjusted taxable income and the interest expense deductibility starting in 2025. So very welcome change here. Another thing that was changed in part of the Trump tax reform, it came into play in 22, was the deductibility of research and development expenses. This was a pay for in the original bill. I'm not sure practitioners or taxpayers ever thought it would come into force, but it did. That required the capitalization and amortization of research and development expenditures. And it was, again, enacted in December 2017, came into play in 2022. Gosh, we saw a lot of clients, not of ours, obviously, but other clients that got somewhat caught flat-footed by this one, and it caused a real cash tax burn. And so there is relief now for domestic research and development expenditures. You can do immediate expensing starting in 25. There's no change to the treatment of foreign research. So foreign research is still capitalized, amortized over 15 years, really driving to get that research back onshore. And you could probably pull a string here to some of the other things going on in the government and economy right now, and it's a similar thread. But there is relief for domestic research and development expenditures, which is great. There is some transitional rules. For some clients, there is some action that's needed by July of next year. So definitely one that we're engaging with our clients on and looking at closely. Another provision for business owners, and this is one that we see in the startup space. Being in Boston, we got a lot of technology companies, life science companies. Certainly been an interesting environment with the economic challenges recently, but there is a further incentive under the qualified small business stock rules that promote investment in small businesses and entrepreneurs and supporting them as they kind of pursue and go through their fundraising rounds and ultimately hit an exit. So the QSBS rules first came out in 93, got a little bit of a booster shot in 2009 and a big booster shot in 2010 that allowed for 100% capital gain exclusion, provided that certain requirements were met. The most pivotal being that you had to hold the stock in the C corporation. It's a C corp provision for more than 5 years. Some of the changes that came in through the OB3 is there's now a 50% gain exclusion after 3 years, 75% after 4, and then still the 100% exclusion after 5 years. So it's nice to see a phase in. It can be difficult for these entrepreneurs and these individuals and other investors when they hit that, having that conversation, hey, I'm 4 years in, I've really hit that number that I'm ready to sell at. But if I wait another year, I pay no tax, so at least now there is a benefit as they get towards that, and it makes that conversation easier. There was an increase from 50 million to 75 million in gross assets, and then 8 inflation adjustments. That's welcome. Again, that 50 million was established a long time ago, so it's nicer to see that. And then there was an increase in the capital gain exclusion. It went from 10 million to 15 million. That's for newer investments, but really, really powerful stuff. One that we know has people challenging again their legal entity structure. Should I stay in a flow-through status? Is it worth being flow-through to enjoy losses, what have you? Hey, if I pay another estimated tax payment, I'll lose my mind. Could I just be a C Corp? We're putting it all in the mixing bowl and definitely having those conversations with clients. Some other changes that came through, just an FYI, we'll go a little bit quicker here in the interest of your time, but pass-through entity tax elections, this is the workaround for the state and local tax deduction limitations. There was talk that these would be curbed or eliminated, no changes, which is good. There is an update for employer-provided meals. So similar to what happened with the TCJA, there will have to be a recoding in some clients' trial balances, make sure we're capturing things correctly. A new floor for deductibility of charitable contributions and ceiling. So just something to be aware of there. Increase in the 1099 filing information reporting from 600 to 2,000. That's a welcome change, kind of cut down on the volume there. Owners of flow-through trader businesses, the excess business loss limitation rules under 461L, which limited you to 500,000. It's inflation adjusted of flow-through losses in the year of origination. That does continue, and that excess loss carries as an NOL. A couple other things. So certainly a lot there for business owners. You probably got the sense in that conversation, it is a pro-business bill and a pro-taxpayer bill. There's a lot of welcome changes for our business clients, and we're happy to see that, and we're certainly engaging with them going through it. So now we're going to turn to more individual provisions. And I had mentioned before where there's a increased focus. There's certain incentives that have came in. We'll talk through some of the campaign stuff, and a lot of the phase outs for these provisions are based on AGI, and in understanding where you're going to fall will impact your ability to claim these. So there's a new $6,000 senior deduction. This is the no tax on Social Security, $10,000 auto loan interest deduction, no tax on tips, $25,000, $12,500 for overtime income deduction, increased child tax credit, QBI deduction if you're in a specified service trader business, state and local tax deduction. So you can see each of these is tied to mainly your modified adjusted gross income or some computation thereof. And so higher income earners will be phased out of these. And so modeling is going to be needed. Where are you? And are there any planning opportunities you could take to lower your taxable income, your AGI, to take advantage of these provisions? I know one of the ones people have been really interested in is no tax on tips. That's one that we have seen some guidance come out recently within the last month, kind of a preliminary list of those industries and occupations that could benefit from that. And so certainly something you can dig up and say, hey, am I in a good category or a bad? Bad news for our staff, they're not in the right category. So we won't get it. Now, it's just on the state and local tax deduction. The one thing there is it is up to $40,000. And then as you go over that, it goes back to $10,000. The other interesting thing is we look at this list of provisions, besides the QBI, I believe, and maybe the AMT, is majority of these are temporary provisions. So a lot of the business stuff we went through, that's permanent, not going to come off. But a lot of these are temporary, scheduled to expire, I believe, in 28, going into 29, when you look at kind of the next presidency cycle. And so it's kind of interesting to see how those will roll off and how those will be managed by Congress and kind of the politicians at that time. Who's going to want to be the guy that doesn't want to say, hey, now you got to pay tax on your Social Security. So it is an interesting thing. Again, a little bit more on the $6,000 senior deduction, and a simple planning opportunity that we're looking at here, and we're going to encourage clients to pursue, is if they are taking RMDs out of their IRAs and they're charitable, or we can charitable inclined, is there an opportunity to use a qualified charitable distribution, a QCD, to reduce their AGI? And allow them to also take advantage of the senior deduction. So nothing too magic here as we look at QCDs, a pretty common place where we can get that deduction. It's a direct reduction to the IRA distribution. It's not an itemized deduction. It does get captured in your AGI, and it would allow you to reduce the AGI and get the charitable deduction. So you can see the benefit here. You can go through the schedule and kind of other deductions and the opportunity to use this to lower your taxable income. You can see you can get all the way up to 12 grand and save a good chunk of money by way of leveraging a QCD. The SALT cap I mentioned, it goes to $40,000 beginning in 25. Scales all the way up 41 to 12. It's not on a normal inflation schedule for whatever reason. And then it goes back to 10 grand. There is a reduction after then. I think as we look at the SALT deduction, you can already see kind of the literature out there, and you'll see it a little bit more on the increased standard deduction on how do you stack these items. Can you prepay real estate taxes? How are you going to do your charitable planning? And really piling these things up in 1 year, not doing them over 2, so you can maximize your deduction in light of the fact that the standard deduction is so high now, right? It's a crazy thing where 95% of taxpayers are just taking advantage of the standard. Now, that number will change with the increase in the state and local tax deduction, but certainly something that people are looking at, talking about, and how do they interplay these opportunities while not leaving cash on the table. Another provision that's come in is a limitation on itemized deductions. It's kind of the new P's limitation. So this is a reduction, a direct reduction in the amount of itemized deductions allowed for high income earners. In essence, rather than getting a 37%, this is the income earners in the 37% bracket, you would only get a tax deduction for 35%. This begins in 2026. And so there is a lot of conversations going on about maximizing charitable planning in 2025 before this comes in. It is only 2%, but it all adds up. So certainly something we're working with our clients on as we enter this fall season. Mentioned previously on Roth conversions, if we went back to the pyramid chart of tax rates, I know I don't have the legacy tax rates, but we're still pretty close to the bottom, the lowest tax rates, for the different groups that we've ever had. And There's people out there, if anyone knows it, let me know, the magic 8 ball or where a tax rate's going to go when you're older. Will they stay at this level? I don't know if Chris knows. I hope he does, because that would be great for our firm. But one of the planning opportunities out there, especially in lower income years, is can you transition funds or convert funds from your traditional IRA to your Roth IRA? And what this shows, this example, is it is truly, truly, truly just a math equation. What is your tax rate today? What would your tax rate be in the year of conversion? And what do you think your tax rate will be when the money comes out of the IRA? If the rate will be the same, and you can see we used a simple 40% here, there's no impact, no real impact. If you think your tax rate today is going to be lower than what it will be when the money comes out, then there's the benefit. And it makes sense to do the conversion. If it's vice versa, you're still in your earning years, and even though you have the ability to do conversions and you'll be in a lower bracket later, yeah, probably not worth it. Now, we do see people as part of their legacy planning say, I understand I may pay more tax now than my kids will when they take it out, when they take this money out after I pass, but I would like to make sure that they don't have to pay taxes in the future. We see that. We do see that, and that's definitely a consideration and a conversation. You can see here as we look at brackets and as people enter that retirement stage or post-retirement, pre-pulling on Social Security, depending on what pockets they're pulling from, where we recommend that these conversions occur. So usually we see them happen all the way up until the end of the 24% bracket. That's usually the ceiling, and we don't recommend people go above that. And I think we'll continue to see a lot of that occur over the coming years. Very common in the financial independence, retire early, the FIRE community, Roth ladders and the like. So it's a really, really effective planning strategy, and definitely something to be aware of. There's an example here. Certainly feel free to snapshot it, look at it. You can see the benefits of it. One of the last things we'll go through is just estate tax. So this is something for, the higher net worth or ultra high net worth clients, and something that's fluctuated. There was a fear that we were going to have a big reversal on the exemption, where it was going to go from the 10 million with the inflation adjustment up to around 13 million, all the way back down. We were going to have a flurry of activity at the end of this year, where now it is permanent. It's $15 million. There is some certainty here. And so clients that are subject to this, you can really do some planning with this certainty through life and death and get in front of this with comfort now. And it's one of those where I know there's been a lot of conversation, some action has been taken, maybe not as much as one would hope sometimes. The other thing is, given the size of the exemption, there's an opportunity to fund non-grantor trust to maximize other tax savings. So we talked about the QSBS deduction. There's an opportunity to replicate that benefit through trust planning. QBI, state and local tax, avoidance of state tax, or state tax minimization, I should say. So there's a variety of different things that can be done with use of trust in gifting that all has to be steered against the loss of the basis step up at the time of death and other factors. But it's good that we can have these conversations, not a, you need to do this in the next 3 months or you lose the benefit, right? So it's a welcome change here. Some other provisions that we did see or that came in here, mortgage loan interest provisions. There was a lower cap. It went from $1 million to $750,000. That's been permanent repeal of the miscellaneous 2% deductions. Talked about the auto loan interest deduction that's available. It is subject to phase outs. Tax credit for contributions to scholarship granting organizations. This is one that kicks in 26. I believe it's $1 for dollar reduction in your taxes for each donation. I think this is going to be a really, really hot provision in 26. And I know that it's one subject to debate. There was a Wall Street Journal article I believe it was Wall Street Journal or New York Times a couple weeks back talking about the potential negative impact of this one. So I do think we'll hear more about that. No tax on tips, no tax on overtime we talked about, and a real curb on a lot of the energy incentives that have been out there. There was a big pullback on that. The last one I did flag here is the individual trust accounts, the Trump accounts, new investment vehicle for kids until they're 18. It's something that's going to come online next year. And another one, kind of stay tuned. I think these things are going to be really impactful for those that have the money to kind of fund these accounts for their kids. There's an ability to roll them into IRAs once they hit 18. And there's a deferral on earnings, all this stuff. So I do think there'll be much more publicity and knowledge is kind of the IRS gets behind this thing and announces how they're going to work. But it's definitely something to pay attention to. So, Chris, that was a tight, crisp, 35-minute overview of the bill. There's a lot here and we could go days and days, but we don't have time for that, unfortunately.
No worries. I appreciate it, Matt. Thank you for sharing all that. I did hear you earlier. One little thing I didn't share, I'm a big fire guy, so I did know those rates. I just don't want to interrupt you. So talk about that another time. Had one or two questions as we have time, but I also just want to thank everyone for coming today. If you have any additional questions, Matt's contact information will be up on the screen momentarily. You can reach out to him at mfoley@lga.cpa. So here it is right here. Thank you for that. So again, if you have any additional questions. So with that, Matt, I'm just going to get into a few of the questions and then we'll go.
Sounds great.
All right.